While Wall Street whipsaws between panic and relief, the S&P surging 9% only to then plummet yet again. The real danger lurks not in the stock market, but in the Treasury market, where we are seeing forced liquidations, margin calls create what Wall Street calls a liquidity vacuum that threatens to pull down literally the entire financial system. And no, this is not fear and mongering or doom and gloom. This is actually what's happening. It's just so few people understand that nobody's really talking about it except for a handful of people on Wall Street. And I want to break this down for you so that you are the best informed investor by the end of this video. You can protect your money and you can make smarter decisions in the coming days. Felix here, and what you're witnessing right now is eerily similar to March 2020, just before the Fed had to step in with unprecedented market support. What's the difference? This time, we have an advance warning sign that most retail investors are completely missing. The guys on Wall Street are talking about it, but they're only sending those research notes to their big clients, the hedge funds and the big funds out there, people with loads of money. You and me, we don't usually get access to that. I'm just very lucky. I've still got a lot of friends who work in banking and we therefore have access to this information. And I think you deserve to have it too. So this is a little bit more complex than, what a clickbait headline would usually achieve. But it's so important that I think it's worth a few minutes of your time to understand what's happening here and make amazing decisions going forward. Here's what matters most in a succinct form. The Treasury market, which is the US government bond market, is showing 3 critical stress indicators that preceded the last 3 major market corrections. And we're seeing institutional money already positioning itself defensively, while you and me, the retail investor, remains very exposed to this massive risk. So in the next few minutes, you're going to learn exactly how this Treasury market crisis is unfolding, the parallels to 2020, and most importantly, how to position your portfolio to not just survive, but actually profit from the volatility. And I'll be covering 5 specific indicators here that I personally use to spot these liquidity crises before they hit mainstream news. And I encourage you to take notes. It really makes sense and you can explain it to other people who then benefit from this. And if that sounds like something that could be really valuable for you to understand, write in the comments down below valuable, and that way I know this is actually landing for you. And I'm going to do one better for you actually, because so many people are struggling right now with their portfolios being down and not really knowing how to position themselves for the rally that will inevitably come after the crash. I'm going to run a special live session for you guys on Saturday at 11 a.m. Eastern time, that's New York time, where for 2 hours I'll cover the actual rules that the most successful investors out there use to build long-term portfolios to retire faster and retire better and come out of this crisis a complete winner. I'll give you some picks that I've got. I'll give you the timing rules. I'll give you how do we find out whether a company is actually good or not in the long term. All of that, I'll break it down for you, but you got to register. It's completely free of charge. felixprehn.org/webinars, where you grab yourself a seat. I'm expecting something like 3,000-4,000 people to show up for that, which is just insanely satisfying because we're making an impact with so many of you. And I really, really thank you for that. I appreciate you wanting to learn and wanting to get better and wanting to get out of the rat race. So let's get back to today because this is really critical. And this Treasury liquidity crisis really does show us, by the way, why understanding these market signals and understanding the market better is incredibly important. So do grab yourself a free seat while they're still available at felixprehn.org/webinar. So what's actually happening here? It's something called the basis trade imploding. Now, this isn't your average market correction. Fundamental breakdown in how markets actually work. The basis trade, and I don't expect you to be familiar with it, it involves hedge funds exploiting tiny price differences between Treasury bonds, US government bonds, and their futures contracts. Sounds boring and abstract, right? Well, it becomes a little bit more exciting and not in a good way. When funds apply leverage of 20, sometimes even 50 times their capital, well, this becomes a powder keg. So think about it for a moment, right? Would you personally leverage your portfolio 50 times over? Well, I bloody hope the answer is absolutely no freaking way. But that's exactly what these sophisticated hedge funds have done. Now, if you're leveraged 50 to 1, even a 2% move in the wrong direction can 100% wipe out your capital. You're left standing naked in the rain. And that's what we're seeing with these hedge funds. And that's why they're being forced to unwind these positions. And it's called forced deleveraging. It's a margin call. And we're seeing them not just sell bonds, we're seeing them sell stocks, we're seeing them sell gold, we're seeing them sell everything because they have to. So it's rather like everybody rushing for the exit in a very crowded theater, except that everybody is carrying 50 times more belongings that they can physically manage. It's a freaking disaster. To complicate matters further, President Trump has executed quite the policy reversal. Remember those tariffs he was threatening? Well, yes, he has effectively implemented a 145% tariff on Chinese goods, and they've just retaliated again. But the market hasn't fully processed what that actually means for inflation, global supply chains. Nobody quite knows yet. The volatility metrics, like the fear index, the VIX, has surged to levels we haven't seen since COVID. And the volatility of the volatility, so the fear of the fear, I know this gets a little abstract, is sitting at about 150, which is just not a normal reading you get in a normal market condition. It tells you, be very afraid, basically. So why is this becoming systemic rather than just an isolated problem? Well, when you have leverage at these levels, you create what financial experts call a positive feedback loop. And there is nothing positive about that except for the name. As prices fall, margin calls cause further selling, which drives prices lower, which trigger more margin calls. So write this down. Leverage amplifies gains and losses. But the losses can happen exponentially faster than the gains. And what's particularly concerning right now is that we're seeing these liquidity metrics. So the Treasury market, which should be the most liquid market in the world, it's the biggest bond market in the world, is experiencing a liquidity vacuum, which means it's really hard to offload things you don't want to hold. The economists that formerly excellent publication, which has now become a complete left-wing basket case, published an article with a rather alarming headline. America's financial system came close to the brink. And for once, the nutters there were right. This isn't hyperbole. The 30-year swap spreads have collapsed. Most people don't know what 30-year swap spreads are. If you're one of those, well, it makes you normal. It means you probably have friends. So it's a good thing. But it's a warning sign that something is really, really wrong here. And then you might have seen these headlines that foreign countries are possibly unloading their US Treasury bond holdings. And that is completely unsubstantiated, even if the narrative itself sort of sounds interesting. But what I actually think is happening here, it's hedge funds and it's foreign banks involved in this trade who are unloading these treasuries because of the margin calls. And do you remember how markets fell in March 2020? Maybe you don't. Have a look at a stock chart. Well, that sense of uncertainty, that feeling that traditional relationships between assets were breaking down, we're seeing those same signals again. Extreme levels in the fear index are, well, having a lot of people rather frightened. And you need to pay close attention to this because these problems don't typically resolve themselves without significant intervention. Now, somebody in my comments said, hey, I had a chat with my Fidelity advisor and I talked to him about the basis trade and he didn't know what it was. And he said, we have 70 advisors here and none of us know what the basis trade is. So this is a load of nonsense. And it just goes to show how useful most financial advisors are, right? I'm not saying you should therefore never talk to one. Obviously, there are some good eggs, but yeah, they just don't know what the heck's going on out there. And what's really fascinating here and perhaps concerning is how these events right now are mirroring what we saw in 2020, just with bigger triggers. So we're seeing bond prices fall. We're seeing yields surge. Now, this is all a bit abstract, but the more these yields surge, it means that interest rates are effectively rising because the market is scared. And this is spilling over into the stock market, where we are also seeing really, really low liquidity. There is no buyers. So if you have a margin call, which means you got to sell something and there are no buyers, well, that's a freaking problem. And that's one of the reasons we're seeing these massive spikes up and down every single day. There's just very little liquidity, so every movement gets massively exaggerated. And then on top of that, you've got the US dollar, which is dropping like a rock, weakest level since July 2023, which is again creating real pressure on exporting economies like the EU and Japan, potentially forcing their central banks to cut their interest rates or start printing money. So let's break down exactly what happened last time. And the timeline is quite crucial here to really understand. So phase one in 2020 was, there was this initial shock. Yields dropped in February 2020. Fear initially drove those yields down. Investors sought safety in bonds. And that's typically what happens. Phase two, and this is where it gets interesting, that basis trade I just described completely blew up March 9th to 13th in 2020. And that's where forced selling comes in. And we're currently living through the same phase here. Now, phase three was intervention on the 18th. The Fed announced massive intervention in what is probably the biggest US bailout in history. Now, finally, phase four was things got a little bit better and the market calmed down. Now, in 2020, this basis trade was $500 billion. Right now, the same trade is $1.5 trillion. Isn't it wonderful how Wall Street learns from its mistakes? They don't. And I tell you why. Because there was no downside. They got bailed out. They thought, well, let's make this trade too big to fail. That way we'll definitely get bailed out. And that's very likely what's going to happen here. So the basis trade is blown up. We've got yield spiking. Liquidity is gone. So the $1.5 trillion question is, what is the Fed going to do? And more importantly for your portfolio, how quickly will the Fed act? Now, the Fed's very aware of what's happening here. The Fed official has a confirmed, he's called Schmidt, which is ironic given that I'm German, is saying we're monitoring liquidity conditions minute by minute. They're completely relaxed over there, which is not something that they usually say unless they're particularly concerned. So here's the dilemma. It's a rather tricky one. They could intervene directly and support the market, which creates, well, an incentive for these hedge funds to keep doing the madness that they're currently doing, which is rewarding crazy risk-taking, right? Which is not going to be very politically, well, who's going to be happy if we're bailing out the hedge funds? Well, hedge funds, but nobody else. But if they do nothing, they risk a global credit crisis and economic meltdown. So the stress doesn't just stay with the hedge funds, it moves to the brokers, it moves to the repo market, it moves to money market funds, and it moves to the whole economy. And your savings account, your pension, they're all connected to all of this chain. Now, complicating this further is that, well, inflation was lower than expected. Yet the Fed seems very reluctant to cut rates because they don't know what the tariffs are going to do. Now, one analyst described the situation as a game of chicken. The market is seizing up, practically begging for intervention while the Fed hesitates due to its inflation mandate and kind of political optics of bailing out Wall Street and therefore be seen to support Trump, right? Which is all very, very weird. Although they were very happy to cut interest rates just 2 months before the election, which tells you something. But anyway, moving on from the politics, I've seen this politics, or rather this market play out before. And the clock is ticking. And every hour that the Fed doesn't do anything, the crisis could morph into something much, much more serious. And I'm not trying to scare people. I just want to make sure that you actually understand this. Like when the Silicon Valley Bank collapsed, right? I made these videos, I explained it to people and saying, people, you shouldn't scare people like that. I'm like, it's not scaring people if you're actually helping them understand what's going on out there so you can position yourself better. So are you positioned for this? Well, first of all, you need to know what data points to monitor. So write this down, right? These indicators are going to give you an early warning signal of what to look at. First, they're Treasury yields. Look at the 10-year yield. If that moves up a lot, we're in trouble. If it starts coming down, things are getting better, right? And you can look that up, just type it in, US 10-year yield. Google will give you the answer. Second, look at the US dollar. How is the US dollar moving compared to other major currencies? Next, and this is something I've been singing about for about 2 weeks now, is watch the fear index. It's called VIX, V-I-X. Again, you can look that up and say Trade Vision or something like that. And it'll tell you if it's going up, people are panicking. If it's coming down below 20, things are starting to normalize, right? Whereas right now, as I'm recording this, elevated level, definitely something to be very concerned about. And my sort of golden rule is generally do very little when fear is that elevated, because usually it means worse is likely to come. What about your portfolio? Well, honestly, the next couple of weeks, or until this is over and the VIX is coming back down, I'd be defensive. And that means maybe have more cash, literally, and avoid leverage positions. That's really avoid it like the plague. I can't really stress that enough, because you don't want to get margin calls, right? That's really, really important. If your portfolio dropped like 20 or 30% next week, would you be financially and emotionally okay? You got to ask yourself that. I'm not saying it's going to happen, but it's a possibility, and we want to be prepared for that, so that if it does happen, we're in a position to benefit from it. And then the midterm, say 3 to 6 months, I'm optimistic. We have to obviously see how the Trump tariffs play out. But I think we're going to accumulate some high quality assets at depressed prices in that time period. And for that, we need to figure out what are high quality assets. I'll run a full session on that on Saturday if you want to come and join me at felixprehn.com/webinar, completely free. And I'll teach you literally how to pick those high quality stocks for free. And for the longer term, just having a well-structured portfolio of quality names, a little bit of a diversification, but only into quality names, not just like everything randomly, is what makes us safe. It is what takes us to retirement. It is what takes us to a place where our portfolio actually looks after us and works for us and becomes a business that gives us income. And that's obviously the longer term goal here. And for people who are setting themselves up now and learning how to pick those great stocks, well, they're going to come out of this smiling. And that's what I want for you. So this Treasury market crisis, basis trade crisis that's unfolding here reminds me very much of 2020. It rhymes with it. To some extent, it rhymes with 2008. And it's a little complicated, so most people don't understand it, and therefore most people are just going to ignore it. Mainstream media doesn't want to talk about it because you lose views when you talk about something complicated. That's just the reality of it. So I'm not expecting this to be the most popular video in the world, but that's not why I make videos. I make videos because I want you guys to get the real financial education that everybody deserves and for you to be in a better place. And really, if I can just share one thing with you, I have a lovely student who just shared this with me yesterday, and he says, I got to share a big mental win. And really what he says, look, I finally listened to all the teachings, and he's made some changes in his portfolio. And then he says, I'm going to take a stress-free nap on my cash bed. And that's really what this is about, that we are in a place, and he says, for the first time in months, I can sleep in peace. Peace of mind is worth a lot. It's golden. Plus, at the same time, he's actually safer than where he was before, and he's going to be in a position to really, really benefit from that. So come and join me on Saturday. Come and learn with us. It's a lovely, amazing community of lots of you who just want to retire earlier, retire better, get out of the slavery of your salary job or whatever it is. Or maybe if you're already at retirement or near retirement, you just want to improve that and accelerate that and make it even better so you can make an impact on your family, leave a legacy, and really do what you're meant to be doing and what you're meant to be, you're put for on this earth for. So I love you for watching. I love you for joining. Sign up for the live webinar on Saturday, felixprehn.com/webinar. The link is down below in the description. And if you got some value out of this, well, share it with a friend. All the best.
It was another wild day on Wall Street, but for the first time in a week, the news was positive. Stocks soaring in response to President Trump's stunning reversal on tariffs. But one country not being spared, the president ramping up tariffs on China by 125%.
At the White House today,